This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Turbulence returns. Stocks soar, then drop, then rise again as the Federal Reserve tees up an interest rate hike for March.
Here comes tech. Microsoft and Facebook, two of the biggest names in an influential sector, report earnings, and the results could impact stocks tomorrow.
Taking off, Boeing stock has more than doubled over the past year, and today the company said it's full throttle ahead. Those stories and more tonight on Nightly Business Report for Wednesday, January 31st.
Good evening, everyone, and welcome. So does your neck hurt a little bit? Well, it very well could from all of the ups and downs in the market today. Stocks leaped at the open, then dropped after the Federal Reserve, leaving interest rates unchanged, suggested that inflation might move higher this year. The gains disappeared then for an hour or so, but then they were found, and here are the day's final numbers. The Dow Jones Industrial Average rose 72 points to 26,149. NASDAQ gained 9, and the S&P 500 was up 1. Now, the choppy day closed out a very strong month. The Dow and S&P extended their win streaks to 10 straight months, and that's something that hasn't happened since 1959. Those indexes also had their best January outing in years, as you can see there. Not to be outdone, oil prices rose 7 full percent this month as production topped 10 million barrels a day for the first time since 1970.
And now to the Fed. As we mentioned, the central bank left rates unchanged at Chair Janet Yellen's last meeting, but it upgraded its view of the economy and expressed greater confidence that inflation will move towards its 2% target. Steve Leisman is in Washington tonight.
Bottom line is the Fed pointed markets towards a March rate hike and gave little reason to change the view that it's on track for at least 3 rate hikes this year. There's even a 1 in 5 chance or a 22% chance of a 4th rate hike this year. The Fed said economic activity, business and household spending, and employment were all solid. It added that it expects the economy to warrant gradual rate hikes in the months ahead and that inflation will move up this year. That's the first time it's been that confident about inflation. Finally, the Fed took the formal step of electing Fed Governor Jerome Powell as chairman of the rate-setting Federal Open Market Committee. That's effective February 3rd. It also said Powell would be formally sworn in for his other role, that's chairman of the Federal Reserve Board of Governors, on February 5th. Yellen leaves her successor a solid economic record to build on. Here's Yellen, though, on that historic day in 2015 when she engineered that first move off of zero interest rates.
This action marks the end of an extraordinary 7-year period during which the federal funds rate was held near zero. It also recognizes the considerable progress that has been made toward restoring jobs, raising incomes, and easing the economic hardship of millions of Americans.
Yellen's main failing and the big challenge for Powell is how to get inflation back up to the Fed's 2% goal and how much rates should rise if inflation remains low. Another challenge is how should Powell think about these lofty market levels and process the stimulus coming from the tax cuts. After 17 years at the Federal Reserve, Yellen will be remembered for her dedication to keeping rates low to give Americans a chance to get back to work. That was despite strong opposition from some Republicans in Congress and even some members of her own Federal Open Market Committee. For Nightly Business Report, I'm Steve Leisman.
So January is in the books, and for the most part, for stocks, it was a straight ride up until the past couple of days. Down days to begin the week, choppiness today. So let's talk about what may lie ahead with Art Hogan, Managing Director and Chief Market Strategist at B. Riley FBR. Do you think perhaps, Art, that the beginning of this week is a telltale of what we might see more of later this year? That is, more down days, more volatility.
I certainly do, and I think if you look at some of the causes for this, I think it's threefold. Certainly we've had a strong start, so that gets ahead of itself a bit. So to come out of the gates and be up 7% as of Friday and 6% at the end of the month certainly is a little too far too fast, and we have to consolidate some of those gains. I think the real consideration here is our interest rates going much higher than they are. So the yield on the 10-year broke out of a 3-year range, closed today at about 2.72. The people that follow us pretty closely are afraid that's going to work its way to 3% in short order, and that starts a conversation about, does that draw money out of equities and back into fixed income, into that safety trade. I think the third thing is this earnings season has been terrific, but it's been noisy. And by that, I mean it's hard to figure out what the new corporate tax rate means for every individual company in the S&P 500. And that's caused a lot of chop during the earnings season. We've got another busy week next week.
So, Art, is that 3% level the magic number that will make people take a second look at the fixed income market and be viable competition for stocks, or does it have to be above 3%?
So can you imagine if you asked me that question when we first met and the yield on the 10-year was, 5 or 6%?
Oh,
no, I don't think
we've
it's a
known
magic
each other a
number.
long time. I think it was higher than that.
I know. So it feels funny to say that, but I will tell you, in the current environment that we're in, and I think the equity risk premium speaks to this, something in the threes, I think it's closer to 3.5, would really start that conversation in earnest. The problem is directionally, when fixed income markets start moving like this and yields start rising, the fixed income market tends to start pricing this in a linear fashion and makes the assumption that we're going directly to 3 and perhaps 3.25% shortly. That probably doesn't happen because we're very, very much still anchored to what German sovereign debts are and the rest of the European sovereign debts. So I think that keeps a lid on this. We'll certainly get to 3%, but I don't think we're going to blast through that and get to something troublesome like 3.5 or 3.75.
Like a lot of people, I'd had a pretty nice year in my 401k. I had a pretty nice year in some other holdings of mine. Is now a good time for me to maybe take my foot off the gas a little bit? And if so, where and how?
I'll tell you, if you've had a pretty good year, I think this is a very good time to make sure your asset allocation model is what you thought it was. If you're a 60-40 person, meaning 60% in equities and 40% in fixed income or bonds, you're probably out of whack already this year, and you certainly are out of whack from last year. So getting back into where you think you are on your asset allocation is always smart to do, and especially this time of year. I think that if you think that you are looking at the beginning of something very large in a correction and we're going to a recession, I think that's probably getting ahead of itself. I think earnings for 2017 were about 12%. 2018 is going to be about 19%. I think we have more good news than bad news, just more volatility.
Judicious trims, not slamming on the brakes. Art Hogan with B. Riley, FBR. Thanks.
Microsoft's results late today could impact the market tomorrow. The Dow component reported better than expected earnings of 96 cents a share. Revenue climbed 11% to nearly $29 billion, which was ahead of expectations. But that may not have been enough for investors, as the stock fell in initial after-hours trading. Josh Lipton has more on Microsoft's quarter.
$5.3 billion. That's the big number in Microsoft's report. It refers to the company's commercial cloud revenue, which jumped nearly 60%. Margins also moved higher year over year. Kirk Materne of Evercore ISI says that's the key focus for investors. Microsoft has become one of the largest cloud platforms, and it's those cloud businesses that will be Microsoft's main drivers of growth over the next few years. Materne says these were strong results, though he acknowledges there were also great expectations, with the stock up strongly heading into this earnings report. For Nightly Business Report, I'm Josh Lipton, San Francisco.
Fellow tech giant Facebook also beat Wall Street earnings expectations. The social media company pulled down $2.21 a share. Revenue up 47% from a year ago to $13 billion. But a shift in strategy and a dip in user engagement sent the stock all over the place in after-hours trading. Julia Borston has the details on Facebook's latest quarterly numbers.
Facebook beating financial expectations, but the company announced a nearly $2.3 billion impact from tax regulatory reform. And CEO Mark Zuckerberg warned that the company's taking short-term pain for long-term gains, saying that after last quarter, Facebook made changes to show fewer viral videos to make sure people's time is well spent. That reduced time spent on Facebook by roughly 50 million hours every day. And with Zuckerberg announcing earlier this year more changes to the timeline, now prioritizing communication between friends over content, he says in this earnings release, quote, by focusing on meaningful connections, our community and business will be stronger over the long term. For Nightly Business Report, I'm Julia Borston in Los Angeles.
Boeing helped lift the Dow today. The world's largest aerospace company reported both quarterly profit and revenue well above expectations. That sent the shares up nearly 5% to an all-time high, making it the best performing stock in the blue chip index. That added to Boeing's hot run this year that has seen the stock more than double. And as Phil LeBeau reports, the company's outlook for the year is still shining bright.
Pardon the pun, but Boeing is soaring. And in 2018, it could climb even higher. In fact, this year the company expects record operating cash flow. Why? Look at the commercial airplane business, where Boeing is increasing production while driving down costs. Meanwhile, its defense business has a record backlog of orders, and military spending is rising around the world. Then there's the benefit of the new tax law, which also gives Boeing more cash to spend on future products.
We will be ramping up our investment in innovation as a result of tax reform in a meaningful way.
There are still some big questions facing Boeing this year, including whether it will succeed in buying Brazilian plane maker Embraer. Boeing CEO Dennis Muilenburg says he still thinks a deal will get done. But even if Boeing does not buy Embraer, Muilenburg believes his company is positioned to fly even higher this year. Phil LeBeau, Nightly Business Report, Chicago.
So let's dig a little bit deeper into why Boeing stock has taken off so much and what could be next for the aerospace giant. Joining us to talk about that is Josh Sullivan. He is a director and senior industrials analyst at Seaport Global. Josh, welcome. Nice to have you here.
Thanks for having me.
You say basically the market is in a phase where cash generation is highly valued and Boeing is right in the sweet spot, right?
Yeah, and Boeing they have $420 billion in backlog, 5,800 aircraft in backlog. They're executing on this delivery or order cycle that's been at the super cycle since the early 2010s. So now we're seeing the benefit of that. As they deliver these aircraft, the cash is just coming through the door. So this morning, they announced that operating cash flow would be $15 billion in 2018. The street was looking for something like $13.5 billion. So if Boeing's being valued off of off of operating cash, we had a step function change in that again this morning. So that's why the stock's working. We're delivering on these backlogs. The market's rewarding cash, and Boeing's right there, just pushing the metrics higher.
There are some stocks, Josh, that I think of as must-owns, core holdings in basically any portfolio. I think of Boeing that way. Am I right, too?
I think you're absolutely right, too. I mean, you look across the industrial landscape, who has this kind of backlog. And then the cycle is also extending. The air traffic growth metrics coming out of IATA continue to be very strong. The cycle has pretty much pointed to 5.5% growth over the last 20 years, and we're getting closer to 7%. And in November, it was up 8%. So the passenger traffic growth, which is the ultimate demand for aircraft, continues to elongate the cycle, while Boeing is already delivering on these record backlogs. So the cash generation, as they increase automation, as they increase their throughput, is very impressive. And then you have new types of aircraft coming online and moving through the production cycles with better price points and better margins. So you're right. There are few industrials in the position that Boeing is in.
How much do you think is left in the stock? It has had such a stellar performance. Do you think there's a lot more to go, or maybe just a little? What's your valuation for it in terms of stock price?
Yeah, I mean, there can be an argument that's made that it's actually undervalued to the other aerospace industrial players like a Honeywell, GE, UTX on a free cash flow basis. So there's actually some room to be made up. So as they continue to deliver that cash, and that multiple is arguably closed between the other players in the group, we think there's a lot more room. And then as far as other levers left to pull, the 737 goes up in rate again this August. It goes up again in 2019, and Boeing's talking about even taking it above 60 at some point. So there remain a lot of levers for Boeing yet to be pulled.
All right, Josh, we'll leave it there. Thank you so much. Josh Sullivan with Seaport Global.
And time now to take a look at some of today's upgrades and downgrades. Love this. All right, we begin with a rare downgrade for Apple, which comes one day before it reports earnings. BMO lowering its rating to market perform from outperform. The firm says the average selling price of its biggest moneymaker, the iPhone, will plateau. Price target cut to $162 a share. Despite the downgrade, though, the stock finished up a fraction at $167.43. Foot Locker upgraded by Oppenheimer to outperform. The firm says Foot Locker will benefit from the innovation happening at Nike and Adidas, Adidas's ongoing momentum. The price target there set at $70. Shares of Foot Locker got a blister, off 1.5% at $49.15.
Fitbit is upgraded at Stifel to hold from sell. The firm cites valuation given the recent fall in that stock price, but the analyst does have concerns about the durability of the fitness tracker market itself and does not see a path to profitability in 2018. The stock was lower by nearly 1% to $5.15. Goldman Sachs removed MetLife from its conviction buy list but maintains a buy rating on the stock. The firm cites uncertainty around a review of its reserves. The price target was cut to $57 a share from $61. Shares fell more than 3% to $48.07.
Still ahead, the push to fix our nation's infrastructure and how it might get paid for.
Job creation got off to a strong start this year. According to the payroll processor ADP, private businesses added 234,000 jobs in January, which was more than expected. Trade, transportation, and the utility sector all showed solid gains, as did jobs in education and also in health services.
Meantime, the country's top public health official has resigned. Dr. Brenda Fitzgerald has stepped down as head of the Centers for Disease Control amid questions about financial conflicts of interest. There have been reports that she bought shares in a tobacco company 1 month into her tenure. The CDC, of course, plays a lead role in preventing smoking and tobacco-related diseases.
The Treasury Secretary called on Congress to lift the U.S. debt limit as soon as possible so the government can pay its obligations. In a letter to congressional leaders, Stephen Mnuchin said Congress needs to raise the nation's debt ceiling soon to avoid a government default. It's estimated that the government could run out of funds to pay its bills by late March if the lawmakers don't act.
And the president wants to rebuild the nation's infrastructure. In last night's State of the Union speech, President Trump put it on the congressional to-do list. But the price tag is prompting some questions, and Kayla Tausche now takes a look at what the White House may be considering to pay for.
After touting passage of tax reform, President Trump renewed his call for Congress to pass an infrastructure plan totaling $1.5 trillion.
We will build gleaming new roads, bridges, highways, railways, and waterways all across our land. And we will do it with American heart, American hands, and American grit.
A White House proposal has been in the works for a year. While details are not yet public, sources say it will include at least $200 billion in federal infrastructure spending skimmed from other agencies, and will aim to streamline the permitting process. But private investment isn't mandatory. The president, sources say, has voiced concerns private sector partnerships aren't effective.
He wants to make sure that if we're asking people to invest, that we're giving them a return on that investment.
Instead, the plan leans heavily on cities and states to create dedicated funding for their own projects. The White House is setting aside $100 billion in incentives for those ideas and $50 billion for rural projects, which the Treasury Secretary said won't be attractive to companies.
It's going to have to be a combination of, as I said, federal dollars, state dollars, and private dollars. There's many, many infrastructure projects that are not going to be privately funded.
There is broad agreement that the nation's bridges, roads, and rails are in need of repair, but little agreement on how to pay for it. The Chamber of Commerce and American Trucking Association want to raise the gas tax, an idea Trump is considering, but Republicans loathe.
We're not going to turn around and raise taxes for infrastructure, period.
On Capitol Hill, infrastructure will be a heavy lift. Unlike tax reform, it requires bipartisan support and involvement from up to 9 congressional committees and 7 federal agencies. On top of that, White House officials acknowledge any progress they make on infrastructure has to happen in the next 6 months, before the August recess and before all eyes turn to the midterm election season. For Nightly Business Report, I'm Kayla Tausche, Washington.
AT&T tops expectations thanks to a larger subscriber base. That's where we begin tonight's market focus. After the bell, the telecom giant reported profits and sales that exceeded expectations as more customers signed up for wireless accounts and fewer left the network. The company is also forecasting earnings for the 2018 that are significantly above estimates. AT&T shares initially rose following the results, and they finished the regular session up a penny to $37.45. Anthem reported quarterly profits that more than doubled and said it sees earnings for the full year coming in above expectations. The health insurer also raised its dividend a nickel to 75 cents a share and said it's actively engaged in its partnership with CVS to create a new pharmacy benefits manager. Anthem touched a 52-week high today and was up nearly 2% to $247.85. And after reporting better than expected earnings, the drug maker Eli Lilly raised its full year guidance. The company said results were helped by strong demand for new treatments.
The beat and the performance is driven by top-line growth from very new products. I think this is what patients want. It's what investors like to see. So a strong quarter for the company.
Lilly did see some weakness in its animal health division and said it's still considering selling that part of the business. The company also says it's experiencing pricing pressure on its diabetes medications. That is what investors focused on, and as a result, sending shares down 5% to $81.45.
The technology company Pitney Bowes said a recent acquisition helped its latest quarterly numbers. The company, which provides businesses with postage meters and mailing gear, topped expectations, also gave upbeat sales guidance. Shares of Pitney Bowes up nearly 12% to $14.11. Higher battery sales helped power profits at Energizer. The results beat street estimates, and the company hiked its earnings guidance for the full year. Shares up nearly 10% to $58.22. The Energizer Bunny powering along. Tupperware said a charge tied to the new tax law erased all of its quarterly profit, causing the storage products maker to report a loss. Still, the results were ahead of estimates. The company did miss on sales, though, and warned that weakness in some of its markets, including the U.S., is going to pressure revenue in the current quarter. And that kept the lid on Tupperware shares. There you go, which fell more than 9% to $57.76. And Japan's Fujifilm will take a majority stake in the iconic American brand Xerox for about $6 billion in a complex transaction that could face hurdles. Fujifilm will fold Xerox into the two companies' existing joint venture. The move is intended to produce cost savings, put the global business under one roof, and quiet activist shareholders, including Carl Icahn. Xerox shares up more than 4% to $34.13.
Still ahead, how hard will the supply crisis hit the housing market this spring? U.S. Foods and Cisco, two large food suppliers, are suing the country's biggest chicken processors for allegedly conspiring to inflate prices. In separate complaints, the companies sued Tyson Foods, Pilgrim's Pride, Sanderson Farms, and Purdue Farms. These companies dominate the chicken sector and have come under increased scrutiny recently when it comes to pricing and production. News of the lawsuit sent shares of all those chicken companies lower on the day.
Well, the rate of home ownership is now at a 3-year high. According to the Census Bureau, the percentage of people who own homes is back above 64%. That number, though still near historic lows, has been rising steadily since 2016. Economists say much of the increase over the past year has come from 18 to 44-year-olds.
A number of new housing reports today show that the hot demand for homes is being met with a cold reality. Prices are high, supply is scarce, and mortgage rates are rising. Now the focus is shifting to affordability. Diana Olek has our story.
Home shoppers are braving the frigid cold, hoping to beat the competition in a market where supply is leaner than ever. The number of buyers signing contracts on existing homes rose about 0.5% in December compared to November and compared to a year ago. The gain, though, should be bigger given strong demand. But the supply of homes for sale is now at a record low.
The inventory level currently is about 1.5 million, and that is the lowest level since 1999, since we began tracking the data. A more normal condition should be about double that number.
That is only pushing home prices higher.
The reason house prices have been growing as rapidly as they have, which is something like 4 or 5 times the long-term average, has nothing to do with credit conditions and very little to do with interest rate. It has much more to do with the lack of supply for entry-level borrowers.
But mortgage rates are now surging. The average rate on the 30-year fixed hit its highest level in 4 years this week. That'll make housing even less affordable, and it will keep some borrowers on the margins from qualifying for a home loan. All eyes are now on the builders. D.R. Horton, which is one of the few big builders to focus on the entry-level part of the market, just reported better than expected earnings. The hope is that corporate tax cuts will help builders ramp up production.
You may get some benefit from the tax cut if builders expand on the corporate side, but it's going to be offset by an increase in incomes for entry-level folks based on either the standard deduction or if the business side picks up and real wages rise, that will touch the demand side of the curve. So we're not seeing a lot of shift in the supply-demand balance for next year, making it tougher for entry-level borrowers.
No question, this housing market is about to be tested. Spring will bring new listings, but it will also bring higher home prices, higher mortgage rates, and even hotter demand than we're already seeing now. For Nightly Business Report, I'm Diana Olick in Washington.
And that does it for us tonight. I'm Sue Herrera. Thanks for joining us.
Thanks from me as well. I'm Tyler Matheson. Have a great evening, everybody, and we'll see you right back here tomorrow night.